According to JPMorgan, shifting just 0.5% of foreign-held U.S. assets into gold in the coming years could be enough to push gold to $6,000 per ounce by 2029. Thursday, June 5th, 2025, Maneco 64, home of alternative economics and contrarian views. We've been covering on this channel the petrodollar. We have a petrodollar files and the fact that China, Russia, and other countries were preparing to move away from the petrodollar. We've been warning since 2017, and we did say that it would be a slow process, but I think it's accelerating now, not just with China, Russia, and the BRICS, but also institutional investors in the West. Of course, central banks continue to move away from the dollar. So that's what we are going to look at today. And before I do, just like to thank all of you for the interest in the channel. Make sure you subscribe to the channel if you enjoy watching my content. I've noticed that almost half of you watch my content but are not subscribed. And yeah, so back to the dollar, back to gold, because that's important. We're going to look at a couple of articles today that shows me that the move into gold as a substitute for the dollar is anything but over. Of course, the dollar, the currency, historically was the substitute for the for gold, because gold has been money and always will be money, and the currency is just like a representation. It's a promissory note for that money. Of course, things have been turned upside down. And the first article I want to bring up is this one, and I saw someone post yesterday on X, I think it was Bob Coleman at Profits Plus ID on X. And he said, according to JPMorgan, shifting just 0.5% of foreign-held U.S. assets into gold in the coming years could be enough to push gold to $6,000 per troy ounce by 2029. And I retweeted that with a comment on top. I said, that's just 0.5%. What if it rises to 5%, right? 10 times. You can figure out that it's going to be a lot higher than 6,000. And he's talking about central banks. He's not talking about investors in general. So let's quickly go through the article where he took that 0.5% from, and it's from AIinvest.com. I hadn't seen that website before. I'm going to put a link to the article below in the description. You can read it. It says gold could reach 6,000 level, and central banks will be the hidden force driving the rally. In this historic bull market for gold, the gold buying spree by central banks worldwide has undoubtedly become a key driving force behind the rising gold prices. Although the true scale of the purchases by central bank moms remains a mystery, few industry insiders believe they will stop in the future. According to the estimates by Goldman Sachs analysts, global central banks are currently increasing their gold holdings by approximately 80 tons per month, equivalent to about $8.5 billion at current prices. So this article is from June 4th, so from yesterday. Most of the purchases are conducted secretly and privately. Data from the World Gold Council leads to a similar conclusion. Central banks and sovereign wealth funds collectively sweep up about 1,000 tons of gold annually. Well, yeah, they've been doing that since 2022. Accounting for at least a quarter of the world's yearly gold production, a January survey by HSBC of 72 central banks showed that over a third of the respondents plan to buy more gold in 2025, with none intending to sell. During periods of geopolitical tension, gold often plays the role of a safe haven. Although this buying wave began before former US President Donald Trump launched a global trade war, it highlights the growing, I'm not sure why they say former US president, he's the president right now, but anyway, the growing concerns of some countries about over-reliance on the world's dominant reserve currency, the US dollar. The scorching rally in gold prices over the past few years has only further enhanced the metal's appeal. One of the most representative examples is the National Bank of Kazakhstan, which was one of the largest gold sellers among global central banks last year. However, according to its governor, Timur Suleymanov, the bank has now returned to being a net buyer this year and plans to continue increasing reserves. A shortcut to $6,000 gold? For Goldman Sachs, the belief that central banks' gold buying spree will continue is a major reason the firm maintains its year-end price target of $3,700 per ounce. As of Wednesday, in Asian trading, spot gold was hovering around $3,365, not far from its all-time peak of $3,500 reached in April. I'm going to skip here to the end, to the important part. You can read the rest. I'm going to put the link, of course, below. According to JPMorgan, shifting just 0.5% of foreign-held U.S. assets into gold in the coming years could be enough to push gold to $6,000 per ounce by 2029. E.V. Hambro, global head of thematic and sector investing at BlackRock, thinks the gold market is large, but the dollar market is even larger. Even a small shift of funds from the dollar market into gold could have a massive impact. So, as to my response of the 5% instead of 0.5%, you might think, well, that's too much. But thankfully, I got some data for you here. World Central Bank reserves in US dollars, gold reserves as a percentage of total reserves. So here, JPMorgan is saying if central banks shift just 0.5% of their dollar reserves into gold, it would drive gold to 6,000. But we can see here that until like the late 80s, central banks kept almost roughly 40% of their reserves in gold. By the year 2000 and since the beginning of the century, it has been more around just above 10%. And you can see that it's rising. It's still below 20%. And back in 1980, of course, that was over 60%. That was because of the gold price rising so quickly. But it could very easily go up to 40%. And that's more than just 0.5%, right? So what I'm trying to say here, that 6,000 forecast by 2029, in my opinion, is very conservative. Am I saying gold is going a lot higher? Well, nothing in life is certain, but if things remain the same, if central banks keep moving away from the dollar, and I don't see any reason why they wouldn't, it's very probable. And it's not just central banks, as I said earlier, it's also big investors. I just saw an article that was published by the FT. The article says big investors shift away from U.S. markets, Donald Trump's trade war and rapidly mounting government debt have shaken confidence in American assets. Big institutional investors are shifting away from U.S. markets as Donald Trump's trade wars and the country's escalating debt fuel fears about dominance of American assets in global portfolios. The U.S. president's erratic trade policy has shaken global markets in recent months, sparking a sharp sell-off in the U.S. dollar and leaving Wall Street stocks lagging far behind European rivals this year. Trump's landmark tax bill, which is forecast to add $2.4 trillion to Washington's debt over the next decade, has also increased pressure on U.S. treasuries. People need to rethink their exposures to the U.S., said Seth Bernstein, chief executive of AllianceBernstein, which manages $780 billion in assets. The deficit has been out there as an issue. It's just getting worse, he added. I think it's untenable for the United States to continue borrowing at the pace it's borrowing. When you couple that with what's going on with unpredictability of our trade policy, it should cause people to pause and consider, how much do you want concentrated in one market? A top executive at an American private capital firm described Trump's so-called Liberation Day, when the president unveils sweeping tariffs on Washington's trading partners, as a wake-up call to a lot of people that they were overweight the U.S. As institutional investors review the extent of their holdings in the U.S., Caisse de dépôt et placement du Québec, Canada's second largest pension fund, said recently it would reduce exposure to the country, currently 40% of its portfolio. It plans to increase investment in the UK, France, and Germany. And this is what is sad here. It says the US has been the best place in the world to invest for a century. So this is really historic, in my opinion. But I'm starting to hear investors question whether U.S. exceptionalism is a little less exceptional, and think about whether to position their portfolios accordingly. This was Howard Marks, co-founder of the $203 billion alternatives manager, Oaktree Capital Management, told the Financial Times. So I'm going to stop here, and my viewers in the U.S. must be asking, how does that impact us? Well, it means there's going to be less demand for the dollar. The dollar is going to be less valuable. And when a currency becomes less valuable, the price of everything goes up. It just means more currency debasement, higher prices. Some people call that inflation. I call it the consequence of the inflation that we've seen for the last few decades. It's the result of inflation. Anyway, let's quickly look at where the markets are this morning. It's 7:30 a.m. London time. We've got spot gold at $33.69, is down about $3. High's been 84, the low's been 61. Silver is up a couple of cents, not much, but at least it's up. It's at $34.52. High's been 61, the low 41. So the ranges have been very narrow, so the markets are fairly quiet, and so are the stock markets. One thing I noticed yesterday is that the bond market rallied. And why did the bond market rally? Even though I'm still bearish long-term U.S. treasuries and other governments' bonds as well. Well, we had a weak ADP jobs number. Of course, the important jobs number is coming out tomorrow, and the bond market rallied. But as I said, I think it's a short-term move. We'll have to wait and see. The other thing I've noticed is that crude oil remains pretty firm. It's at 62.25. High-grade copper That's approaching $5. We're at $4.94, so keep an eye on that. And with that, I'm gonna wish you all a very good day. Take care. Bye.